You want to be investing in a company when they're roughly 12 months away from being able to raise a Series A. And so for any particular company, we try to figure out, hey, what are the true Series A milestones for this company? And then do we believe that the company's at that point in time where they can achieve those goals within the next 12 months?
Hey everyone, this is Prashant and I'll be your host for the VC10X podcast. And today we have Richard Kerby with us. Richard is a general partner at Equal Ventures, where they're investing in retail, insurance, supply chain, and climate sectors at the seed stage. In this episode, we talk about how Equal Ventures got started, how they evaluate startups, interesting portfolio companies, how they conduct due diligence, and some mistakes that emerging managers should avoid. So without wasting any time, let's dive straight in. Hey Richard, so good to have you on the VC10X podcast. How you doing?
I'm doing well, Prashant. Thanks for having me.
Yeah, it's my pleasure. So to start things off, can we have your story and how you started and why you started Equal Ventures?
Yeah, sure. So, started off my career after graduating from Georgetown at Credit Suisse. So, it's an investment bank here in New York City. Was actually in the industrials group there. So, very boring things that we were working on. Think of like, steel, lumber, paper, all the things that, make up what's all around us, but, very, very important parts of the economy effectively. And then, yeah, after 2 years there, we moved to the West Coast and joined IVP, Institutional Venture Partners. It's a later stage fund in the Bay Area. When I was there, our check size was more than $30 million range, and I'm sure now they write much larger checks. The firm's gotten much larger as well. But had a great time there. Was fortunate enough to work on a number of awesome investments in great companies like Dropbox and Shazam and Fleetmatics and many others. And then, yeah, after that, moved to join Venrock, a Series A focused firm with offices in the Bay Area, New York, and Boston, and had a great time there as well. Got to work on awesome companies there as well, like Six Sense and many others. And so, had some good learnings at both the later stage as well as the early stage. And then, after that, joined forces with my partner Rick Zullo to start Equal Ventures. And at Equal, we focus on leading and co-leading seed rounds. That's typically a founder raising $3 to $5 million, and then we're investing $1.5 to $2 million in those companies. And so, with that, we are a generalist firm, so we invest across a wide variety of categories, but do have some areas where we spend more time than others, and they tend to look more legacy-like, kind of like the boring things I used to do at Credit Suisse. But they tend to be really large markets where tech adoption is still very, very limited. And so that's kind of a quick summary of Equal and myself prior to Equal.
Yeah, sounds awesome. And to be specific, you have your focus set on these five core sectors, which are retail, insurance, care, supply chain, and climate. So, why you have picked these five sectors and why they are promising to you in terms of venture capital?
Sure, yeah, and I think for us, the sectors of focus for us are always rotating in or out. That's just the flavor we chose at the moment, and I think the underlying theme across all those categories goes back to what I said before. These are industries that have very large market opportunities, trends, and catalysts that are going in their favor, and tech adoption hasn't really caught up to other markets in particular, and so we look for opportunities in those categories. And even though we may invest across a number of different categories that may seem unrelated, a lot of them actually are connected. So when you think about supply chain logistics, that's the movement of goods, and that has obviously implications on retail as well as insurance because you have to insure these goods. And so a lot of things are actually interconnected amongst the categories we spend time in. But I'd say the overarching theme as we think about these companies is kind of twofold. One is we're generally looking for a lot of vertical software. So a founder or team that's actually building software for one specific category, and they're improving that workflow in some form or fashion. And then they're finding an alternative way to monetize. And that alternative way for us tends to be around some sort of like financial service. They think of like transactional revenue. So maybe payroll, maybe payments, insurance, commissions, take rates, things like that. And so that's a common theme across our investments. And the other common theme is, B2B marketplaces. And so once again, even though these categories may look very different, the underlying, revenue model actually doesn't differ all that much across our portfolio for the most part.
Yeah, absolutely. And when you're evaluating all these companies across these sectors, what are you actually looking for in companies to see if they're actually good fit or not? What are the questions you're asking these founders to see if they can actually make it big or not?
Yeah, and I mean, we probably asked too many questions if you ask the founders that we talked to, and so there's definitely a long list. But I think at the end of the day, we're asking these questions to figure out what the core questions are for any opportunity, and I think the core questions tend to be different depending on what the category of company is, but they're usually two or three that ultimately matter. But if I had to summarize it in a shorter fashion, I'd say we're trying to suss out is this the right team for this particular product and category is one thing that we're definitely spending lots of time in and doing cycles on. And the second thing we're trying to understand is um, uh, what's the pain point that you're solving for and what's the magnitude of that pain point. How big is the reward for solving that pain point? And then the last piece I'd say is trying to see if we get conviction around why the solution or strategy they've chosen is the right one to go solve the pain point and win the marketing category. And so those are the three things that are probably overarching across everything we look at. And then the sub questions are more specific to the category, the company, the team, etc.
Yeah, got it. And one thing that I noticed on your website that it clearly states that we are only investing in a very concentrated set of companies. It's not like you're
Hmm.
making a lot of investments and then hoping like some of them will work out. Not a spray and pray approach, right? It's more concentrated. You're more concentrated in the companies that you're investing in. So why have you taken this approach? And how do you make sure that the companies you actually invest in actually succeed big?
Yeah, yeah. So for us, we do, limit the number of companies that we invest in on a fund basis and on a yearly basis too. So we invest as a firm in about 4 to 5 investments per year. And so, there's two of us that are partners, and we have, three folks that support us on our team. And so think of it as 2 or 3 deals per partner per year is effectively what our model is. And the reason why we're so concentrated is that we spend a lot of time with our founders, right? And so we're on the board of almost every company that we invest in, and we think that having a dedicated partner to your business is important to hopefully increasing the chances of success for that particular company. And so that means we're interacting with our founders quite a bit. I'd say the longest we probably ever go without speaking to all of our founders is probably 2 weeks. And that's because we have, scheduled calls every 2 weeks, but we're also all speaking to them ad hoc via text and email and phone calls in between there. And so it's a lot of contact with the founders, and it's not meant to be intrusive or overbearing. It's just trying to make sure that we're finding as many ways as possible to be as helpful as possible to those companies. And so that means spending time really trying to figure out and align on like what the strategy is near term and long term to go win, aligning around the milestones that are necessary to achieve for that next round of funding. For us, the next round is going to be a Series A. Three, what are those really key hires that the company needs to make, and so settling on what those should be, but more importantly then go find those candidates and helping the team go do that. And then maybe more important than that is helping to close those candidates, because it's one thing for the team to go about it, but whenever you can add an technically outside source to go ahead and validate the company and the solution set and the team, that it can go a long way and hopefully closing really high quality, great candidates. And then, then last, I think it's thinking about how we can help our founders de-risk funding risk for the round that we're investing. So helping them catalyze and complete that round, but also thinking about future rounds. And so for that, we're really trying to pinpoint who would be the best downstream investors as a fit for this particular kind of company and category, to hopefully not waste our founders time by talking to the entire ecosystem of every investor, because that can be time consuming when you're trying to build a business.
Yeah, that sounds great. Like I love when investors say that okay, we are only investing in a select few set of companies, and then we are going to go all in on helping those companies become successful. And I see Equal Ventures taking that approach. Great. So, are there any interesting portfolio companies that you'd like to mention on the podcast that are doing great work?
As we're kind of like parents to our portfolio, and we love all our babies, and so we like them all.
Right.
But I guess, yeah, you're asking for a few specific ones, and so one company to think about in our portfolio is a company called FreeFlow. They are in the insurance and benefit space, and so what they do is they provide free software to benefit brokers to enable them to manage their RFP process, and with that, insurance carriers come in, bid on businesses, and then bind policies on the platform, and that's how FreeFlow ends up monetizing their business. And so it's a really clever way of getting your software situated into a very important part of the value chain. In this scenario, the benefit broker that controls the end customer as well as who wins a bid on the other side of of the space here, the carrier of that scenario. And so that's been one that's been particularly exciting for us. Actually, I think it was our first core investment in the fund. So it's great to see an early investment do so well. Another company that we're excited about is a company called Wrapbook in our portfolio. They do payroll processing and insurance for the entertainment industry. And so, once again, back to what I said before, vertical software for a category where you can monetize in a transactional manner that fits to a T here, as it did for 3Flow as well. Um, One more to throw out there is a company called Ghost, and they're a marketplace for excess inventory. And so, we're doing this podcast, what, November 23rd here. Summer in New York has definitely passed. And so, if you're a retailer and brand and you've got, summer apparel, it's time for you to get those off your shelves and inventory. And so, traditionally you may have sent that to, I don't know, TJ Maxx or Marshalls or someone like that. And so that was a very manual process of collecting goods, trying to take pictures and create these, manual lots. And then what Ghost enables them to do is create digital lots, upload their inventory very efficiently and effectively, and then had that sold to the right buyer on the other side, whether that be a brick and mortar off price retailer, a liquidator, distributor, wholesaler, international buyer, marketplace. The avenue to kind of have these goods taken off your inventory is actually quite large, and a marketplace model in this scenario is a great way to make it work while also preserving brand equity. You don't want the consumers to think of your brand as being a lower cost brand than it is. And so making sure you can obfuscate that is very important as well for the model.
Yeah, absolutely. That was a great set of companies. I'll make sure to put the links to all those companies in the blog post that'll go along with the episode. Besides, let's talk about due diligence, something that has brought into focus these days because of the recent events that are happening in the industry. So, how do you conduct due diligence on the companies that you're investing in?
Yeah, yeah. And so it kind of goes back to what we discussed earlier. It's really trying to figure out what are the key questions that matter for that company. And so, our diligence process is part trying to figure out what really matters, and then part figuring out how do we get answer those questions that arise from the process. And so that means we're spending a lot of time talking to folks within these industries. And so, we mentioned a few companies before. In the case of, let's say, 3Flow, that meant to talking to benefit brokers and insurance carriers to understand how they operate is, and trying to validate was the pain point that the team was suggesting to us real, and was the solution one that they'd be receptive to. And we got to check mark, check mark, check mark there, and made that investment. Similar for Wrapbook, we were speaking to folks that were previous employees at incumbent competitors in the space, previous production coordinators who felt the pain point as the end user of the product, and then folks on the payroll side at production companies. And so all those three constituents are really, really important to understanding the dynamic at play there, and getting the kind of feedback that affirmed to us, the pain point was real, the solution was appropriate, and the founding team spoke the language of the market were all important. And we also spent a lot of time with the founders on that side too to help us answer those questions and understand, hey, does this founder really have like strong command of their category? Are they an expert in their category? We never want to be the experts in the category. If we're simply just educating someone else the entire time, that's not great. And vice versa, we don't want a founder just educating us the entire time too. We want it to be a two-way street, and we're trying to make sure that that dynamic exists to hopefully lead to a fruitful relationship over time. Because these investments are hard to unwind. You're on someone's cap table for many, many years, and you're on their board for a long time, and you're hopefully that's going to be a very lucrative and friendly and fun partnership together.
Right, absolutely. And one more thing I want to talk about is portfolio construction. Since you're only investing in about 4 to 5 companies in a given year, so are you taking into consideration that okay, we want to cover all these 5 sectors that we focus on, like let's invest one in each sector or something like that? So how do you go about constructing a portfolio that's both in a certain way diversified, as well as you're making really promising bets?
Yeah, so like, what that means for us at 4 to 5 investments a year, it's roughly trying to aim for a portfolio size of roughly 20 companies. We may not get there on every single fund, but that's, effectively what our goal is. Um, Being that concentrated does mean that you can't be right, too many, or sorry, can't be wrong too many times, because then you're going to have, probably poor returns in that scenario. So, our hit rate has to be higher than if we had a much larger portfolio. And we think by increasing time spent with our companies, we hopefully increase the success rate of those companies over time. And so that's a big portion of what we're trying to, analyze and figure out over time.
Got it. And what stage are you typically coming in and making these investments?
Yeah, so we focus on leading and co-leading seed rounds, and so I know that the seed round definition is murky these days, but I think the way we try to define it is we want to be investing in a company when they're roughly 12 months away from being able to raise a Series A. And so for any particular company, we try to figure out, hey, what are the true Series A milestones for this company? And then do we believe that the company's at that point in time where they can achieve those goals within the next 12 months? Sometimes the companies that we're looking at are actually 24 months away, and that's probably too early for us. And sometimes they're right there, and that's probably also we're too late in that scenario. But the companies that we look at and invest in, they can get there at various points in time. And so depending on the model, like you could be 12 months away from raising a Series A at launch or pre-launch based on what you're building. And for some companies, it takes 3 years or 4 years. And so when we have that wide spectrum within our portfolio, companies that we've invested in that were before launching, and companies that had been around for several years before actually kind of hitting scale. And so we, don't knock a company for taking too long to get there, or if it's their second seed round or bridge round or extension, we think that's fine. It takes some companies a little longer to get there, but once it's figured out, things can grow quite quickly. And so in those scenarios, we're always happy to be a lead investor. And so for us, it's the round directly before the Series A, and we don't really care what you call it.
Absolutely amazing. So you were recently a moderator for a session on fundraising for emerging managers in the New York Tech Week. I would like to ask, what would be your advice for emerging managers, or what mistakes should they avoid? Maybe for the managers who are now looking to raise their first funds.
Yeah, yeah. So we held a 1 day summit called the Emerging Manager Circle Summit, and it was call it 75 GPs, 75 LPs for a day of content, networking, etc. And it was a great time, and so we're happy to kind of contribute to the emerging manager ecosystem as best as we can. And yeah, specifically to the point you're asking, I think raising a first time fund is quite challenging, no matter who you are for the most part, and we experience that ourselves. Um, Advice I kind of think about is a couple fold. One is, talking to folks that did it before you. I think when we first started, we didn't do that enough. And that led us to make mistakes that we could have probably avoided had we just talked to folks and told and asked what the right way to approach things were, what to avoid, etc. And then the second piece is do your best to kind of like pre-qualify LPs that you're speaking to, because I know for us we thought like anyone who had money was a potential LP, which in theory is true, but if your product offering is not in their sweet spot of what they're looking for, then you're wasting your time there. And so really trying to figure out, hey, do they invest in first time funds? Do they invest in emerging managers? Do they invest in the categories you're spending time in? Do they invest in the geos that you want to invest in? And so all these things are criteria that you can use to kind of suss out whether spending time with a particular LP is worthwhile or not. And so a lot of the things I'm thinking about are the same things that we tell our founders when they're running their business or raising capital. Unfortunately, we didn't listen to our own advice in the early stages, and so hopefully we will going forward, and others will as well.
Great. And you mentioned about the mistakes that you made when you were starting out that you wished you had avoided. Was it about just this thing that, okay, we wish we like pre-qualified the LPs before reaching out to them, or were there more mistakes that maybe the emerging managers who are listening could potentially avoid?
Yeah, I think the pre-qualification was definitely a big one.
Hmm.
Um, I think that the second one was optimizing around storytelling. I remember in an earlier version of our first fund deck, we were trying to educate like the LPs on like the market dynamics in the emerging manager landscape. And like I remember one LP mentioned, hey, like we're LPs. We're the expert on this on the table. Like, don't tell me this, right? And we were wasting like probably like 3 slides on trying to dictate that to them. And so that enabled us to cut out, things that did improve our storytelling, and we could focus on more about like, hey, why should equal exist, and why should YouTube be doing this? And those are the questions that the LPs really cared about. And so, really trying to figure out what matters most to LPs, and trying to keep the story as tight as possible was something that we had to improve on from the very, very beginning. Um, Making sure I think you've got like a reason for your fund size and portfolio construction is very, very important. And having some thought to that rather than just being like, I'm raising X because I want X. I think it's important because it just shows the command you have for the product that you're offering to LPs. Um, and so I think those were like some of the big things where we could have done better out of the gate that what might have made that process more efficient, and hopefully others can do so and avoid some of the pitfalls that we had.
Pretty incredible. And my next question is going to be exactly the same. Like, what is your pitch? Maybe let's say that we are the LPs or the listeners are the LPs, and
Sure.
why do you think equal ventures should exist in a world full of VC funds?
Yeah, there's tons of fun. I think the differentiation question that LPs ask to me is always the hardest question to answer because we can give you an answer, but if you fast forward the portfolios of like 10 different funds, we're going to be in a lot of the same companies, right? And so we're outputting very similar things. And I think what founders have resonated with Equal is a couple things. One is being that lead investor. Oftentimes you're raising a seed round, you actually have plenty of capital that's committed to the round, but that capital is like committed contingent on the lead investor and the price for the round. And so we're happy to go ahead, lead and catalyze that round, which I think is adding value because while the seed stage market is quite crowded, the landscape of lead seed funds is nowhere near as crowded. Secondly, spending time in a few categories that we rotate in and out of allows us to have some connectivity, some expertise, some knowledge and that enables us to speak to a founder more of in a conversational manner rather than a pitch. And so, many times the first, I don't know, 3 or 4 slides of a founder's deck is like educating the investor on the market. And we can tell them, hey, we know the space, we're bought in on the category. Let's just save your breath there and focus much more on the important things, like which is, what are you doing? What are you building here? And why are you and your team the best folks to go do that? And I think it's a nuanced statement, but changing it from a pitch to a conversation to folks that have an interest in a space, brings the guard down on the investor side and enables the founder to feel much more comfortable with who they're speaking to. And I think that preparedness on that side enables the founder to actually believe that you can be helpful. And we try and demonstrate that before making investments. So in the diligence process, we're hopefully introducing the founder to potential customers, potential hires, and so forth to demonstrate why giving up a meaningful part of your company and giving us a board seat is worthwhile for what we think we can add value wise.
Absolutely, yeah. That's a great differentiator. Now, coming on to my last main question before we move on to the rapid fire section, and this one is about the research that you have previously done on inequality in the venture space. So, can you share some of the insights that you found there? And is the name Equal Ventures also kind of inspired from that inequality that you saw?
Yeah, and I think there's definitely lots of inequality within the venture landscape. Just look at the demographics of who firm owners are, GPs at firms, even the non-GP employees at firms. It's not representative of what the United States looks like in particular, and so it's a something I'm passionate about trying to improve on, work on an almost daily basis to try and improve on it, and we'll keep doing so until it's more reflective of what we see within the broader U.S. population. And yeah, on the equal name, there was a lot of things that went about into that. One, my partner and I, Rick, are equal partners in the fund. Two, to the point you made, we think there should be equal access for any entrepreneur wherever you are, regardless if it's your first time having a company, regardless if you're in the Bay Area, regardless if you went to Harvard or Stanford. None of those things matter to us. It's more about equal access to everyone because our viewpoint is like talent is equally distributed, but access is not. And so hopefully equal could be a part of that. The other piece and component to that was we thought that there should be equality amongst every person in the value chain within venture. So like equality between LPs and GPs, where that dynamic can oftentimes be trended in one direction versus the other, and similar on the founder side. So equality amongst the founder and GP as well, so that there's respect and mutual respect on both sides. That hopefully that can lead to the most productive conversations, relationships, and partnerships. And so it meant a lot of things, and hopefully that continues to persist.
Yeah, absolutely. That's awesome to hear. And now moving on to a rapid fire section, which will be basically 5 questions about the fund, and you have to give 5 quick answers.
Sure.
Are you ready for it? All right. So the first one goes, what are the sectors and regions you invest in?
Yeah, regions, pretty much anywhere. We also invest outside the United States, but predominantly US focused. Sectors, it's a broad range. We are a generalist firm, but some spaces we spent some additional time in have been around e-commerce enablement, supply chain logistics, climate, construction, insurance. But yeah, at the end of the day, I'd say think of us as like vertical focused software with fintech revenue model as well as B2B marketplaces.
Great. And what's the typical stage of investment?
Yep, seed stage investment for us, call it a $1.5 to $2 million check.
Great. And you already answered my next one, which was about the typical check size. So I'll move on to the next one, which is where can founders pitch you?
Yeah, so we're pretty available everywhere, and so my email is just Kirby at equal.vc. It's very easy to guess. And then on Twitter, I'm just at Kirby, and so also very easy name to remember on the handle perspective.
Absolutely. And the last one is where can our listeners follow you? But I think that's more or less the same answer, right?
That's right. That's right. Got sorry for pre-answering your questions.
That's cool. You're preempting my questions. Amazing. So I'll make sure to put all those links in the show notes below. Thank you for coming on, Richard. Love the work that you're doing and happy investing.
Prashant, thanks so much.
My pleasure.